Hello friends. On this episode of the Adams Chetwood video newsletter, we're going to talk about FOMO investing. And for those of you who are not familiar with the phrase, FOMO simply stands for the fear of missing out. And I should also say there's a supplemental video that'll be helpful to accompany this video that is called Why We Don't Try to Time the Markets. And I'll put a little link below this video so that you can check it out for further information. But FOMO investing is really this fear of missing out on the market. And there's a bad application of it and a good application of it. And I'm going to try to explain that by using two charts with you. The first is the fear of missing out when all of your friends are talking about how much money they made in this stock or that stock, and they've seen just ridiculous gains and how smart they are because they were able to get in the stock at just the right time. And we've used this chart before, but I'm going to go back to this chart from Carl Richards that talks about this behavioral pattern that a lot of investors get into and how it leads to their underperformance when it comes to their investments. Even though the number one rule in investing is that you want to buy when things are low and sell when things are high, what we find is that a lot of people do exactly the opposite, even though they know better. So they will experience FOMO, or the fear of missing out, when their friends are talking about this company that has just gone bonkers and they're up 200%. And so they'll think, well, boy, maybe I should buy some of that. And so they buy some of that company at elevated prices. And then they experience some routine market turbulence and they say, you know what? They start second guessing themselves. I just can't handle this. So then they sell the stock low, and they have by definition bought high and sold low, even though they know that they're supposed to do the opposite. And that is a recipe for disaster. So that kind of FOMO investing, we don't want you to participate in. We don't believe that that is wise. But there is a FOMO investing that I do want you to participate in. And it's really a derivative of this chart that we get from our research partners at JP Morgan. And there is a lot of really good stuff in this chart. It's basically looking at the rates of return over a 20-year period of time. And I want you to look at the 20-year period of time that they are measuring, January 1st of 2001 through December 31st of 2020. And I want you to know that we've had some pretty severe turbulence during that period of time. The 2001-2002 dot-com bubble bursting led to a downfall in the market, a temporary decline in the market. We've talked about that on other videos. 2007-2008, boy, that was painful. And so what you saw were a lot of people who wanted to try to get out of the market, and so they missed out on the subsequent recovery. And so this talks about if you had stayed fully invested over this 20-year period of time in the American stock market, we're just going to use the S&P 500 as a proxy. If you had stayed fully invested, then your rate of return would have been almost 7.5%. But think about that over a 20-year period of time and 365 days a year. That's a lot of days that you would have had to be fully invested. But what if you just took off 10 of those days? What if you just said, you know what, I can't handle it. 2008 is really stressful. And you missed out on the 10 best days. Your 7.5% rate of return would have gone down to 3.3%. If you missed out on the best 20 days, you would be barely above even. If you missed out on the best 30 days, now that's like 6,000 days that we're talking about. If you missed out on the best 30 days, then you would actually be negative, and you can see, as we go out 40, 50, 60 days. What's amazing about the market is that turbulence, as we've said on past videos, is not a matter of if, but when. But one of the things that you find is that the best days to be invested usually follow the worst days and the scariest days to be invested. They even listed out here for you that 7 of the best 10 days occurred within 2 weeks of the 10 worst days. And so this is why whenever we have periods of turbulence, we believe one of the best ways that we can help clients achieve financial peace of mind is to lift their gaze a little bit and say, hey, when do you need this money? Well, I don't need it for 5 years. I don't need it for 10 years. Great. then let's not touch it. Let's stay invested during periods of turbulence so that we don't miss out on the recovery, because as we see in this chart, missing out on the recovery can really be detrimental to you achieving your financial goals. I hope that's really helpful. If you have any questions about that, or if you have friends or family that would have any questions about that, feel free to forward this video to them and they can schedule a call with us, and we're happy to get to know them and talk with them about their financial future. I hope that's helpful, and I hope you have a wonderful day.